One of the most frustrating things about getting a mortgage is finding out what your credit score is. You see, credit scores play a very instrumental role in the actual rate that you get. And the lower your score, oftentimes the higher your interest rate and the higher your cost of private mortgage insurance. And in some cases can get in the way of you even getting that mortgage. Now, what I find over the years is that many people believe they have perfect credit because they pay all their bills on time every month. But there's a little secret that a lot of people don't know, and that's how managing your revolving credit card balances can impact your credit score more than anything else. I'll give you a little secret. When you get your bill, and most people, they get the bill, they pay it. And I hear that countless times. I pay my credit cards off every month. But when I get the credit report, I see a big balance. The reason is when that credit card company sends you the bill, they're also sending that to the credit agency. And that balance stays on that report for 30 full days, almost as if you never paid it down. So the key to optimizing your credit report is to pay that bill 3 days before the statement cycle ends, so the balance on that bill is as low as it can be, and your credit score is as high as it can be. So if you're buying a house, this is one of the most important things for you to know. If you have any questions about your mortgage and how your balances impact your interest rate, feel free to reach out to us anytime.